Okay, let me get started. First of all, thank you very much to Nick and Steve for having me on the program. This is joint work with my colleague Pietro, who was here yesterday, but who unfortunately is teaching right now. And this is our second paper on the topic of financial effects of political uncertainty. So we've heard a lot of excellent papers on the real effects. Here we focus on the financial effects of this uncertainty. In particular, we're interested in how asset prices respond to political news. And we know they respond. Let me give you a few examples, starting with the Eurozone debt crisis. There's an example we give in the introduction of a Greek prime minister who said about a year ago that maybe Greece should hold a referendum on the bailout when at the EU summit its debt was cut by half. In response to this statement that maybe we should hold a referendum, the stock market in Europe dropped by about 5%, and it dropped by about 3.5% here. And then when the Greek opposition said a couple of days later, well, maybe we don't need a bailout after all, stocks came back up. A more recent example, a couple of months ago, the German Constitutional Court ruled that it's okay for Germany to participate in the permanent bailout fund, and you saw a vigorous stock market response. When I presented this paper in Spain a couple of months ago, the Spanish economists complained that the Spanish market barely responded to any economic news, such as a big labor market reform that they apparently had, but it always responded when somebody from the ECB or Germany spoke. In the United States, we saw many examples last year during the debt ceiling negotiations, but even today, so 2 weeks ago, I wake up and I see the stock market went up 1.5%. And I didn't know what the big news was. The big news was apparently, according to the headline, that, quote, U.S. stocks open higher as investors see signs of, signs of progress in fiscal cliff negotiations. So signs of progress in the resolution of the fiscal cliff was enough to raise the market by 1.5%. In contrast, think about this morning. This morning we got an employment report, one of the biggest economic pieces of news we get, and there was a surprise. It was a good report. What did the stock market do? Exactly nothing. Okay, the market is pretty much flat in response to an employment report, but it responds to signs of progress in fiscal cliff negotiations. So it's a bit of a shame that we don't really have a conceptual way of thinking about how these political signals or shocks affect prices, and that's what we try to do here in this paper. In particular, we develop a model. So it's a theory paper. We develop a model in which stock prices respond to political news. You'll see they respond to news such as the government doing something. If the government does something, market will respond. But more interesting, there will be a response to signals about what the government might do in the future. In fact, that's the main channel that we explore here. Okay. And in this model, we have the government taking an active role. So the government in our model is not just a player. It's not just a referee, it's a player in the field. The government will be making an active decision about which policy to adopt. Okay, that's going to be the role of the government. And there are two types of uncertainty about government policy in our model. There's uncertainty about what the government's going to do and what the impact of its actions is going to be. Okay, so think of it as maybe there's uncertainty about whether the healthcare reform will be implemented. And then even if we knew whether it will be implemented, there's uncertainty about what the impact of the new healthcare environment on profitability is going to be. Okay, and both of these uncertainties show up as essentially standard deviations in our model. Let me give you a preview of the predictions of our model. So the first result is that political uncertainty commands a risk premium. And this is non-trivial because I'm going to show you that political shocks in our model are orthogonal to fundamental economic shocks. So even though they're unrelated to economic shocks, they will command a risk premium. Okay? Think of it this way. We don't really know how the fiscal cliff negotiations will end at the end of the year. And it's pretty clear that however they end, it's going to be uncorrelated to the economic news we're going to get over the next few days. But those orthogonal shocks will command a risk premium. Moreover, that risk premium, its magnitude is going to be larger in weaker economic conditions. So I'm going to show you that political shocks, these political signals when politicians speak, they matter a lot in bad times when the economy is weak, but they actually don't matter at all in good times when the economy is strong. Now, there's an offsetting force in our model, which you'll see, which is really the government's put protection, if you will. In our model, you're going to see the government will choose to step in and change things around when things are not going well. So in that sense, there will be a Greenspan put-like feature of the model that if something is not working, the government will step in and throw it out and replace it with something new. And that is a good thing. That is something that's going to put a floor under stock prices, loosely speaking. So there's a good side of the government stepping in and changing things when they're not working. There's a bad side of the government, which is that we're going to be unsure about what exactly the government's going to do when it changes its policy. Because the government has a lot of choices. There are various possible resolutions to the fiscal cliff, and we don't know which one will be adopted by the government. So those two forces, uncertainty on the one hand and put protection on the other, are going to battle it out, and either one can win in terms of its effect on the risk premium. We also show that when things are really bad, in dire economic conditions, the put protection effect tends to be stronger than the uncertainty effect. In intermediate conditions, it tends to be the other way around, at least for a simple parameterization. And then the model also predicts that political uncertainty should make stocks more volatile and more correlated. Okay, more volatile because stocks will respond to these political signals. There's this additional shock when politicians speak, prices respond. That's where the volatility is going to come from. And they're going to be more correlated because government actions affect everybody, as opposed to just, say individual firms. Moreover, those effects on volatilities and correlations are going to be stronger when the economy is weak, because again, that's when the government's going to act in our model. And also when there's more heterogeneity in the government's policy choices. So think of it this way: the fiscal cliff is coming up, and depending on how many different choices we have for the resolution of the fiscal cliff, the effect would be larger or smaller. If we believe that all the potential resolutions look very much alike, then there's not going to be much of an effect. But if we believe that there are big differences between what might be done, then this will matter. So these will be the predictions. Let me tell you about our model. And the first thing I need to say is that you'll see it's a very simple model in that it neglects many important things that economists like to put in their models. So there are many things you'd like to see that you will not see. But on the other hand, I am going to put in some things that you typically don't see. So it's going to be simple in some ways, but maybe not in others. So one simple thing is right here. We model the firm's the production side in an extremely reduced form way. We basically say the firm's profitability, or the return on capital, follows a very simple process. So these Z's are Brownian motions, stochastic exogenous Brownian motions. Those are the fundamental economic shocks in our model, by the way. And the drift of this process, or the average profitability, if you will, depends on the prevailing government policy. So if the current policy is good, its G is high. If the current policy is bad, its G is low. Now, that G has a T subscript, but even though it has that subscript, it really is a step function. So G is constant as long as the same policy is in place. If the government chooses to change its policy, and it can do it at an exogenously given time tau, then the value of G is going to change from G0 to some new value Gn, depending on which of the n new policies the government's going to pick. Okay, so think of it this way: the government has an option to retain its current policy at time tau, or it can change it to one of n new policies. So there are n plus 1 possible policy choices. This is the way to visualize what's happening in our model. You go from time 0 to cap t, and at time tau, the government's going to make its policy decision. It's the only decision the government's making in our model. And it can either keep the current policy, policy 0, or it can choose one of n new policies. If the policy is changed, then G, the impact quantity, jumps. Up or down, we don't know.
But we know Gn. So here you are modeling the uncertainty about which one is going to implement, but not the effect of the policy. So when we see G,
Both things will be uncertain. So two kinds of uncertainty. First, we don't know which of the N+1 policies will be adopted. And two, we don't know G. Everything. Correct. In fact, that is coming up. Thank you. So the first kind of uncertainty is uncertainty about impact. We don't know G. We don't know the impact of Dodd-Frank on the private sector. We're going to learn about these Gs. We start with prior beliefs. And those beliefs are generally heterogeneous across policies. We may have different beliefs about different policies. And then we're going to update those beliefs we're going to learn about G by observing realized profitability. So anytime you see firms, you see the private sector doing better than expected, you revise your beliefs about G upward. Anytime you see aggregate profitability lower than expected, you revise it downward. So nothing special here, plain vanilla Bayesian learning about G. So you see that G hat, the posterior mean of G, that's our perception of the impact of the current policy, follows a martingale. This is a plain martingale process driven by surprises relative to expectations. And G hat is an absolutely crucial quantity in our model. G hat, you'll see, is the only economic state variable in our model. So when G hat is high, we are in a boom. When G hat is low, we are in a recession. There are no other economic state variables for simplicity. We are adding actually an extension with an additional economic state variable. It should be in a new version early next week. But there's just one economic state variable here, G hat. Okay. And we're learning, so uncertainty about G declines deterministically over time. Now, what happens if the government chooses to change its policy at time tau? Well, in that case, we stop learning about the old G, and we begin learning about the new G. So in our calculations, we replace the posterior of G0, which is the impact of the first policy, 0, by the prior of the new policy, N, which is the one that comes in. Note that there's no learning about the potential new policies before those policies are implemented. So think of it this way. Before time tau, which is the time we're interested in, we're learning about the impact of the current policy, but not about any of the new policies. And then if policy N comes in at time tau, then we're learning about that policy.
Could policy N have been replaced in the past, so you're using past history as well to figure these out? I guess that's going to show up in how you set these priors.
Exactly. So think of it, suppose that policy N was there before time 0. I would interpret that as sigma Gn being low for that particular policy. Now, the other kind of uncertainty we have is uncertainty about what the government's going to do. And for that, I need to show you the preferences in our model. So our investors have extremely simple preferences, the simplest preferences we could think of. Yeah?
But the G's are correlated, so you learn something for G and you know something from G -1, or
You always learn only about one G at a time.
no, but then
So
you have some information about one G. Is it relevant for your updating history?
No. So whatever you learn about G0 doesn't tell you anything about. Correct. In other words, all the way until time tau, your beliefs about Gn are the same, are equal to prior beliefs. There's no updating. No updating about the future ones. Yeah. So our investors have an extremely simple utility function, expected utility, power utility of terminal wealth. And that terminal wealth is given by adding up the capitals across all firms. So that's how we sort of close the equilibrium here. Our government, when the government makes a policy decision, it maximizes a function that is very similar but not quite the same. So it's maximizing, it's going to choose one of these N+1 policies, and it'll be the policy with the highest value of this, which is the same expected utility, except it's multiplied by this quantity Cn, which differs across policies. So Cn, we interpret that as a political, sort of non-pecuniary political cost of choosing policy N.
Can investors write contracts over date 0 over what policy is chosen at date tau, insurance contracts?
Let me think. We do assume complete markets.
Including over this, the uncertainty over which the policy regime is.
Well, you cannot, let's see.
I mean, they
Now, we assume you can...
never observe like, which are the actual outcome of the regime, and so
Yeah.
they always build it in the prices, so there's really nothing to contract.
Right. You can contract on, you can hedge against shock, learning about C, which is coming up, but not about the actual outcome.
So what things are you trading? I mean, given that if you're actually doing what the Brownian increments were, you get back out what the G was, so you're not doing that, so you're disguising that.
G is perfectly correlated with profitability. So with this,
But you're not trading the original printing of Brownian increments, because if you do that, you could then figure out what G was.
we assume complete markets. So in whatever shocks. So yeah, I'll show you all the shocks. So the shocks are, I showed you our fundamental economic shocks.
So you're going to trade the Z's? Then why can't you back out the G?
You're trading the Bs.
The B's, I mean. The B's
We don't observe Zs.
I haven't told you about market value. You trade stocks.
Okay, so you're only going to trade the B's.
But Zs are unobserved, I think.
You trade stocks, and we will assume that's coming. I'm running ahead of myself, that there are complete markets. So any C shocks, I'm going to call them.
Something here has to do with whatever is revealed by those
Correct.
B's.
Yeah. So these political costs, what are they? First of all, note that if all these C's were equal to 1, then the government acts as a social planner, right? So we are deviating from that, kind of the fundamental assumption of political economy is that the government is not a social planner. So we're stepping away from that. We're going to assume that these C's are equal to 1 in expectation, but they can deviate from 1. In particular, a particular policy, say a labor market reform, might be costly to the current government. If the French government undertakes the labor market reform, it's likely to be kicked out at the next election, right? So that's politically costly to them, and that would have a C bigger than 1. 1 minus gamma is negative. Whereas other policies, maybe some redistribution policies, might be good for the government, and they might improve their re-election chances, so C could also be smaller than 1. The key assumption here is that C is unknown. Okay, so our investors don't know C, and that's why they're not going to know exactly what the government's going to do in the future. They're going to learn about C over time. And it's uncertainty about C that gives rise to this political uncertainty, which we interpret broadly as uncertainty about future government actions. Investors have prior beliefs about C. Very simple. We work with log of C because it's more tractable. And yeah, so the expected value of each C is equal to 1. In that sense, in expectation, the utility function is the same as for investors. In that sense, it's a benevolent government, but it's quasi-benevolent because it's going to depart randomly from that objective function to the left or to the right, and we don't know which. Now, note that we're modeling the government as having these somewhat distorted objectives, but an alternative way of thinking about this is that the government is actually perfectly, has the same objective function as investors, but it faces these unobservable and random political constraints that are hard for us to interpret, right? Think about all these Republicans who signed the pledge never to raise taxes. Well, we don't really know what that means. Maybe they're willing to renege on that. Maybe they are willing to limit deductions. Maybe they are willing to let the Bush tax cuts expire and then cut taxes maybe by 1%. We don't know what exactly that means. So that's an alternative interpretation. The key is that we're going to be learning about the C from signals, and that's going to generate these political shocks that will move prices.
So does the government, they don't know C either, or they do? That's what I wasn't sure.
It doesn't really matter because our government doesn't do anything other than at time tau, looks at the values of C which are revealed at time tau, and then they take the action.
Okay, because that's what I thought. I mean, sometimes they don't know. I would assume the government doesn't always know. You put the policy in place and then somebody loses an election, right? So that's the political cost to it. Is that the idea you have in mind?
No, these C's are revealed at time tau.
Right, so you make the policy and then some guy gets kicked out, he loses his chairmanship, or like, there's an election. I mean, those are the political costs, or he stops getting political contributions from some agency.
These C's, before time, here's what happens with C's. You learn about C's until time tau, and then at time tau they are revealed, they're drawn. As soon as they're drawn, the government will respond and act, and then markets will respond to that instantaneously. Big T is the end of the world. Yeah, that's when agents. So our agents.
No, in your model, there is only one government that lasts until the other.
One government, yeah, no re-election, no repeated game, nothing, very simple.
That's why we can interpret C as uncertainty about future political.
Yeah, it's a reduced form way of thinking about all these other concerns. I should say that you see how we are somewhat naive about how we model politics. We take all the concerns from political economy, redistribution, special interests, etc. We bundle them together in this quantity C. And all we care about is that it's random and there's learning about it. So you learn about all of the above in political economy. A natural next thing to think about would be to be more specific about where C comes from. And then there could be some interesting links between political economy variables and financial markets.
Or even closer to your current setup, is just exogenously there's a resetting of the C's before you have a decision point. Because as I understand the model now, you're gradually going to be narrowing down your range of uncertainty about the C's prior to this event. In which something happens in terms of the decision.
So you're saying that the C's could jump, shift?
Exactly. We could just restart the learning process about the C's before we actually got to the point of changing policy.
We could do that. That would make, let's see.
You kind of built in a monotonic relationship between distance from, at least in expected value terms.
Right.
Decision point and uncertainty.
Correct.
About what the government's going to do. And that's just a feature of the model. It doesn't have to be that.
If C were to jump in the meantime, then that relationship would not be monotonic. I completely agree. Okay, so this is crucial. Agents receive signals about these political costs. So political cost C is unknown, and the signal, this is just a continuous time way of writing signal equals true value plus noise. So this is the steady flow of political news that we get. When Angela Merkel says something about how Germany's thinking about Eurobonds, we're getting signals about Germany's attitude to the possibility of choosing Eurobonds as a solution to the Eurozone crisis. When markets responded 2 weeks ago to that news about signs of progress about the resolution of the fiscal cliff, these are the signs of progress, these little S signals. So we take those signals, we update our beliefs about C, and it's the same kind of Bayesian learning. You see that C hat, the posterior mean, follows a martingale, and our uncertainty about C declines deterministically over time. For simplicity, we assume that C and G are completely uncorrelated, so these two learning processes are running side by side. These shocks, these Brownian motions, or equivalently these political signals, is what we call political shocks.
Because is this important that C and G are, apart from simplicity, you think that it would make a big difference? They were correlated, because I would think that if policy has a positive impact on the economy, probably that affects also the cost for the government of interest.
If you were to build in some correlation between G and C, I think you could. You could argue that when things are going badly, when G hat is low, that's when political benefits from doing pretty much anything are high. The government wants to be seen doing something when things are not going well, regardless of whether doing something is good or bad. So you might want to build that in. I think you could make an argument. It would make our double learning problem intractable. We thought about it. And loosely speaking, I think of it as adding a term, as adding some sort of a term to all of our expressions that would reflect the correlation. But I can only give you conjectures, unfortunately. So those are the political shocks that we're dealing with here. So this is sort of a bird's eye view of our model. Before time tau, and we are interested in what happens before time tau, so before the resolution of the fiscal cliff, before Europe decides what to do with its problem. Before time tau, there are these two types of learning going on. There's learning about impact, which is going to give rise to impact risk, which I'm going to introduce in a moment. And there's learning about these political shocks, which is going to give rise to all these political risk premia our main results. So our main results are all going to come from, well, mostly from that top learning. At time tau, when these Cs are revealed, the government makes a policy choice. It chooses one of these n+1 policies. Now, how do they choose their policy? I'm going to show you. We can, in this simple model, we are able to get closed-form solutions for everything with a lot of insight. So let me define a utility score of policy M, or N, as mu tilde of that policy. So, a policy M has a higher utility score than policy N if and only if it gives higher utility, expected utility to the agents. And those utility scores turn out to have a very simple expression where it's sort of a mean variance type of perspective. Agents like policies with high expected impact, and they dislike policies with an uncertain impact. So agents don't like policies whose impact on the private sector is uncertain. Okay. So agents want their government to pick the policy with the highest mu tilde. But remember, the government pays attention to these political concerns as well. So what the government is going to do, and that's a proposition, the government is going to optimally choose the policy with the highest value of mu tilde adjusted for the political cost. So that's where the deviation is going to, from the social planner, is going to come from. One interesting corollary of this is that policy changes will take place in bad times. In particular, it's optimal for our government to change its policy, to replace policy 0 by one of the other n policies, if and only if g hat, the posterior mean of the current policy's impact, is sufficiently low. In particular, if it's below this threshold. Okay? So if the current policy is perceived as sufficiently unproductive, it's going to be replaced by the government by a new policy. In that sense, the government provides put protection to the market. If things are not going well, the government is going to throw away what's not working and putting something that is expected to work better, or should be expected to work better. Know that there are these political costs that show up in the threshold. Remember, these are uncertain, first of all, so all the statements here are probabilistic statements. What this means is that, I should put this up, investors don't know those future political costs, so they cannot fully anticipate what the government's going to do. What this means is that when g hat is sufficiently low, when we are in a recession, the probability of a policy change is high. It's not guaranteed, but the probability of a policy change varies with g hat, with the strength of the economy. Okay, so now I can move on to, yes, please.
So by assuming the independence between C and G, I think you're also implicitly assuming that the government doesn't take into account that it reveals something about its type when it chooses G. So, because the agents, you could think that they would take G as a signal about the type of the government. And that would be part of the agent's posterior information set, right? If the processes were not independent.
Okay, if they were not independent, then, then by getting signals about the strength of the economy, you would be learning about the government's private benefits or political costs.
I think so different types of government would prefer different fiscal policies.
Mm-hmm. Yeah, this is certainly outside the model that we have. I should say that there's symmetric information here. So it's not about the government signaling its type or anything like that. The government is learning about G and C in the same way as investors, except learning about C is inconsequential, but yeah. So let me move on to how we calculate stock prices. The stock of firm I is a claim on the liquidating dividend at time cap t. Firms don't pay dividends here. They reinvest all of their profits. Why? Because our investors don't consume until time capital t. So it is the natural thing for firms to do. We have, so the market value of any stock is the expected discounted value of that final dividend. Now, how do we discount? With our complete markets assumption, we get the state price density that follows from the objective function of investors. Now you may be wondering, well, how can you? So in particular, this is not completely innocuous in that we are using the risk-free bond as a numeraire here. You may, those of you who are interested in asset pricing, may be used to seeing utility functions with intermediate consumption, and then the smoothing motive is what we use to infer the interest rate, to pin down the interest rate. Here, our agents are not smoothing over time, so there is nothing we can do to pin down the interest rate in this very simple model. I cannot tell you anything about the interest rate. So one way to think about it is that we choose a zero risk-free interest rate. Another way to think about it is that we solve for the price of a zero coupon bond that matures at time t, risk-free zero coupon bond, and we use it as the numeraire. So anytime I talk about the stock price, think of the stock price divided by the price of the zero coupon bond that matures at time capital T. Those are equivalent interpretations.
You're effectively trading here the signal on C's too, I guess.
That's what I meant, yeah, that you have to be able to hedge that, those what we call political signals. Yeah. So the first thing we do, although this is not really our emphasis, is we get a closed-form solution for how the stock market's going to respond at time tau to the announcement of policy N. So we solve for this announcement return, and instead of giving you the closed-form solution, let me give you kind of just one interesting corollary, which is that for any pair of policies M and N, the ratio of the gross announcement returns is given by this relatively simple formula. What's interesting about it is that the formula contains the utility scores mu tilde for both policies M and N. Now, if this second term wasn't there, then you'd see that a policy with a higher utility score would also have a higher announcement return. But the second term is there, so you could conceivably have a policy with a higher utility score and a lower announcement return. In other words, we cannot judge government policies by their stock market reactions. If the government chooses a particular resolution to the fiscal cliff and the stock market drops by 3%, it doesn't mean that that new policy is necessarily bad for welfare. It could be welfare improving, but maybe it is sufficient, maybe its impact is sufficiently uncertain that stock market investors will dislike it, even though in terms of utility it might be an improvement. Okay? But keep in mind that, you know, we're not paying attention to what happens in the bond market here. Or alternatively, these are announcement returns after we take you know, the numeraire into account. Let me not go there. More important, and this is what we focus on, stock prices in our model are driven by three types of shocks. There are capital shocks, so this is the stochastic discount factor, and market prices are also driven by the same three types of shocks. There are capital shocks, which are boring, which are unrelated to the government, so I'm not even going to spend time on them. Then there are impact shocks related to learning about G, and then there are political shocks related to learning about C, about the political costs. Okay? So capital shocks are simply induced by the fact that aggregate total capital fluctuates. Impact shocks are driven by the same Brownian motion. Actually, you see that the z hats here are the same. But these are shocks related to learning about G. So remember when, actually I should show you that the two shocks are perfectly correlated, and we call them economic shocks when you take them together. What's going on? Why am I separating them? It's very simple. When you see profitability that's higher than expected, two things happen. First of all, you have more capital instantaneously because the growth rate of capital is higher. That's the capital shock. But second, you revise your beliefs about expected future growth upward, and that's the positive impact shock, and that's good news also. So I'm separating the learning effect from the non-learning effect. It is useful because one of them, the impact effect, is going to be state dependent, whereas the other one is not going to be. It's through the impact effect that the put option is going to show up in my results. And then finally, political shocks reflect learning about political costs. They're orthogonal. They're driven by a different Brownian motion. And we have a little corollary showing that sigma pi n, this market price of political risk, if you will, goes to 0 when g hat goes to infinity. What does that mean? When g hat goes to infinity, that means we are in a nirvana state. This is, economic conditions are infinitely good. Well, in infinitely good economic conditions, the probability that the government's going to change its current policy is exactly 0. Okay? So in that case, we're not going to pay attention to any signals we get about the potential new policies, because none of the potential new policies will be adopted. We know that for a fact. So you already see that in the limit, when times are really good, political shocks are not going to matter in our model. They will matter quite a bit when times are not good. I want to show you some pictures to illustrate all of these, all of the important mechanisms. And for that purpose, I'm going to choose a two-policy example. There's a policy with a high amount of uncertainty and a policy with a low amount of uncertainty. And just for simplicity, we make them give agents the same amount of utility. So agents are indifferent between whether the government will pick policy H or policy L. In terms of the parameters, this model is too simple to allow us to match any moments. We don't attempt to do that. So we just pick some sensible parameters. Actually, many of them show up in our early, we have a first paper which has a simpler model, no learning about political costs. So in that first paper, we don't get any of our main results. And from that, we just take the first 8 parameters straight out of that model, use the same parameters. We tie our hands. We have 3 new parameters to add. One of them is the precision of political shocks. So we make that precision the same as the precision of economic shocks, or the signals about G. And then we have to pick the uncertainties about G for the new low risk policy and the new high risk policy. And we choose values 1 and 3, which straddle the 2% value that we had chosen for the old policy. So these are like the first thing you would do having written the first paper. We did not fish for any parameters. Okay, now this is an important figure that nicely illustrates what's going on in our model. On the x-axis, you're looking at our measure of economic conditions, G hat, the posterior mean of G, the only economic state variable in the model. So as you go to the right, the economic conditions are good. As you move to the left, the economic conditions are bad. On the y-axis is the level of the stock market index of the current policy before time tau. This is a snapshot taken 1 year before time tau. Okay. On the y-axis is the level of the stock market index measured by the market to book ratio, but for simplicity, think of it as the level of the S&P 500 index. Okay, so the question I'm asking here, how does the level of the stock market depend on economic conditions? Okay. Now, look at the solid line for now. I'm going to illustrate both economic shocks, which are horizontal, and political shocks, which are vertical. Let's start with economic shocks, so horizontal. In other words, look at the solid line only. That's our baseline calibration. Forget about the other 2 lines. You see that the solid line is increasing throughout. Okay? The stock market is higher in good conditions, not surprising. What's interesting is the nonlinearity. In particular, the line is kind of steep in intermediate conditions and also in good conditions, but it's pretty flat in bad conditions. It doesn't really matter whether G hat is minus 1.5% or minus 2%. The stock market value is about the same. That's the put option effect from the government. Essentially what's going on is that in good times, we don't expect the government to change its current policy. So shocks about G, learning about G, impact shocks, are permanent. They're here to stay, and they have a big effect. In bad times, though, learning about G is less important because those G shocks are temporary. We expect the government to change its policy in the future, so it doesn't really matter whether we learn the current policy is, it doesn't really matter whether the current healthcare system is bad or very bad, because we know the new one is coming. We know Obama was reelected, so the new healthcare thing is here to stay. It doesn't matter what we learn about the old one. So in that sense, you see that the relation to G hat is pretty flat down here. Okay? And you see that this hockey stick-like pattern, those of you who have done any finance at all will recognize it as a call option payoff. The payoff of a call option with respect to the underlying looks just like that. If you're a stockholder in our model, you're holding a call option on economic conditions. Why? Because the government wrote a put. Okay, so there's this put call parity, loosely speaking. If somebody else writes the put, you end up holding the call. And that is precisely what's going on. So that's why we give it this put option interpretation, in case you had been wondering when I talked about it earlier.
Lubos, the reason it's most steeply sloped left of 0 is you're most likely to switch there, because that's when G is negative, but you don't switch at 0 because you don't want the extra risk from switching. So, like call options are most steepest at the strike.
That's right, because this is a subtle effect. When G hat is close to 0 and actually mostly slightly negative, that's when the probability of changing the policy responds to G hat. So that's where the effect is coming from. Over here, the probability of changing the policy is 0. Over here, it's 1. In this intermediate region, when we observe G hat, as we update our beliefs about G, we're also updating our beliefs about whether the government will change its current policy. And that's where the steepness is coming from. Yeah. Okay. And so that's the economic shocks, the call option and the put option interpretation. Look at the political shocks now. So now forget about, now look at the 3 lines and compare them. Here's what we're doing. Unlike before, which is I was holding the C shocks, I was holding the political cost expectations constant. Now I'm going to change them. Now I'm going to ask, what happens if I perturb the agent's beliefs by all of a sudden making the risky policy H, more likely? So I'm going to take the risky policy C hat, and I'm going to move it by 2 standard deviations. What happens? Well, I'm making the risky policy more likely. The stock market's going to drop by about 8% in response. Okay. If I make the safe policy more likely by 2 standard deviations, the stock market's going to go up by about 8%. The interesting thing is, these differences only occur in bad states of the world, when G hat is low. In recessions, the market's going to respond a lot to political shocks. Okay. When Joan Boehner says something about what the Republicans might be willing to do on the fiscal cliff, the market is responding now because the economy is not exactly doing well. But in good times, when the economy is booming, there's no difference between the 3 lines. John Boehner can talk and talk and talk, and markets will not listen, because it doesn't matter what we learn about the potential new policies, because we know that none of those new policies will be adopted anyway. The government's going to stick to what has been working if things are going well. So you see the state dependence of political shocks right here. And it shows up in the risk premium. So in this chart, the X variable is the same as before. Look at the top chart only.
Is given by the fact that when you choose the policy or you change the policy or not, you don't know your seat in the government? So
The government...
Good times, it could be that there is a change of policy, not because the current policy was bad for that condition, but because C is different, for example, no party is elected.
Okay, so these are probabilistic state. In fact, I can use this chart down here to answer your question, turns out. Down here, you're looking at the probability of adopting a given policy, and there are 3 policy choices, one of which is the old one. And that's a function of G hat. So what you're saying, so suppose we are in good times. Suppose G hat is high, positive. You see that the probability of the old policy goes to 1, slow, but it's never exactly 1. It's never 1 because even in good times, the government could change its policy if it gets a draw of C, which makes it really like one of the potential new policies. If it derives a political benefit from a particular reform, then it's going to implement that reform even if the agents wouldn't want that. So it just, in the limit, that motive disappears. Up here, you're looking at the equity risk premium on the y-axis as a function of the economic conditions. And it has 3 components corresponding to the 3 types of shocks that I introduced earlier. The blue area is the boring one due to capital shocks. We don't need to talk about that. The green one is the area corresponding to impact shocks. Those are economic shocks associated with learning about impact, about G. And you see that in good times, that is a big premium. That's here, it's the biggest component of the premium. But in bad times, that actually kind of dwindles. That's the difference between the temporary and permanent nature of those impact shocks that I mentioned earlier. We're actually adding some results, some corollaries that are beautifully showing the size of this area, or rather the impact risk premium in the limits. It turns out when times are good, in the limit, the impact risk premium is proportional to capital T minus little t, which is today, because the shocks, G shocks, are permanent. But when G hat goes to minus infinity, that impact risk premium is proportional to tau minus little t. In other words, the shocks are temporary. We expect the policy to disappear at time tau. So that's what you're seeing here. That's the put option. The government's going to throw away the policy that's not working. That reduces the impact risk premium. However, that good side of government is offset to a large extent by the red area, which is the political risk premium. So that's uncertainty about future government actions. And agents demand compensation for that uncertainty. They only do so in bad states of the world, because that's when the government is likely to do something.
If I go back to your stochastic discount factor, it looked to me like the instantaneous risk prices are all constant. This is often includes filter changes. Your state price density, the loading on all the increments there was all constant.
Actually, I wrote them as constant, but they're not constant. So there are t subscripts. There should really be, yeah. Everything depends on t.
So you know, it's like sigma pi zero with the t. Okay.
Yeah, we chopped off the t subscript.
So both of those things are appearing over time.
Absolutely, and we are adding, and we are adding
Some plot out what the prices are doing. I mean, I get down to the premium error when I unbundle in terms of just how the exposures are changing and the prices are changing.
We could do that. Let me keep that in mind. Again, what we're adding to the paper, what you don't see in the current version, you will next week, is the characterizations of sigma pi 0 and sigma pi n in both limiting cases. And those are informative. What happens in between is not, we can get it tractable, it's not insightful. We could still plot it as you're suggesting. Okay, I don't have much time left, but so we do some parameter changes. Suppose sigma g goes up. Suppose political signals become more precise or less precise. And all of those shapes, the composition of the risk premium then changes. But the basic idea, which is that the red area is big on the left side in poor economic conditions, and the green area is small to the left and large to the right, that does not change. And all of these effects are intuitive, and they're discussed in the paper. We also ask what happens when we change policy heterogeneity. So suppose that the potential solutions to or resolutions to the fiscal cliff are very different from each other. Then it turns out that more heterogeneity, so think of it as the dashed line, tends to translate into larger risk premia than the case of less heterogeneity. Okay, but only when economic conditions are poor. Perhaps more important is to show you the correlations and volatilities down here. So forget about the top two charts. Here you're looking at stock volatility as a function of economic conditions. And here you're looking at the average pairwise correlation, actually between any pair of stocks, because they're all the same, as a function of economic conditions. And you see that correlations and volatilities are higher when economic conditions are weaker in our model. And that's solely due to political uncertainty. If we shut down political uncertainty, if I make heterogeneity 0, then all of these lines are flat. So in our model, the only reason why volatility and correlation is high in bad times is political uncertainty. We did that on purpose. Okay, we talk about the jump risk premium. Essentially, those holding stocks at time tau during the instant of the announcement are going to demand a premium of about 1% in the baseline calibration. I have about 1 minute to talk about our empirical analysis, and that's enough, I guess. So we do a kind of a baby test of our model's predictions. In fact, the main purpose of this slide is to show you what the predictions are. So one prediction, the model predicts that there's more political uncertainty in weaker economic conditions, because that's when the government is more likely to act. Political uncertainty should command a risk premium. That premium should be larger when the economy is weaker. And then 4 more predictions. There should be political uncertainty should make stocks more volatile and more correlated, and both of those effects should be stronger when the economy is weaker. Okay, so 7 predictions total. And we test them using this brilliant index that you've never heard of, the Baker-Blumen-Davis index. Actually, Nick already showed a chart. So this is just to illustrate what happens here. Post-2000, look at the red line. That's their index. And look at the blue line. That's the average stock correlation in the S&P 500 index. Take all 500 stocks, take all pairs of the 500 stocks, calculate realized correlation using daily data within the month, average it, and you see that they line up pretty nicely. It's pretty striking how well their index lines up with the average correlation. We don't do anything about causality whatsoever. This is really a theory paper with some empirical illustration at the end. So I'm going to skip all these tables and simply conclude. We have a theoretical model in which stock prices respond to political news. And in this model, political uncertainty commands a risk premium, which is larger when the economy is doing worse. And it also makes stocks more volatile and more correlated, especially when the economy is doing poorly. So thank you.